What is up? This is the Working Investor. In this video, I'm going to talk about my entire portfolio, and we're going to talk about how much dividend income I'm roughly generating recently in the past couple of months. We're going to talk about where I'm going to go forward from here in the portfolio and all the mistakes I've done, I've learned along the way. Maybe I could learn a thing or two from you guys, or maybe you guys could find some value from my experience. Nothing here is any type of financial, tax, or legal advice. This is just my personal journey as a fellow retail investor like you guys in the trenches, just sharing my journey. So I call this the YieldMaxian portfolio. I have like a growth portfolio as well, because most of my assets is basically YieldMax. The highest position is YieldMax. It's like 42% of my portfolio. Then AIPI from RecShares. It's an AI thematic fund. RDTE is on the Russell from Roundhill. I have some interesting thoughts about Roundhill. We could talk about that in a different video. Then we have LFGY. This is a weekly pair as well, just like YieldMax is a weekly pair. They basically, do a whole bunch of stuff on Bitcoin related assets. GPTY is like, again, a YieldMax item. And they also do all kinds of strategies on, kind of like the tech AI sector, sort of. And then you have SPYI. So here are my S&P 500 cover call ETFs: SPYI, XDTE, SDTY, SPYI, and now we're starting to go into some of the other stuff. So from SPYI and onward, these are sort of starting to get, more wisdom in the portfolio, and these are more of my like hedges and building into strengths. So YGLD is basically some gold exposure. I can get into. I have videos in almost all my holdings. CLOZ is a CLO, a basket of CLOs. IYRI is real estate, and CEFS is closed-end funds. Berkshire Hathaway Group B. So now you're going to see that a lot of my stuff I have, not everything pays dividends. A lot of it is actually non-dividend, because I do want to have some non-capped upside in my portfolio. I need to look at all my vulnerabilities and try to counteract my vulnerabilities with some strength. And a lot of times people have a portfolio that's mostly dividend income, but then they have satellites of growth. And some people structure portfolios that are basically comprised of growth, and then they use satellites of fixed income. So it depends how you want to play it. So this is more of an income portfolio with some satellites of growth. IDVO is international exposure. So this is my first international exposure in this portfolio. It does give monthly dividends. SHLD is no dividends at all. It sounds like Shield, and basically it's the tech security sector, defense sector of tech. Now, SPMO is a new holding I put on today, and this is basically momentum of large caps. And I have videos on all these ETFs. CGDV, I just made a video on that as well. This is basically Capital Group dividend value portfolio. It's really not a lot of dividends, so it's kind of misleading. I wouldn't even consider it dividend. I mean, we're talking like sub 2% dividend given out quarterly. It's more for giving myself a tilt on the deep value sector. So I look at Berkshire Hathaway Group B, and I look at CGDV as my value deep value tilt, which also beats the S&P historically. And then I have BIZD as well, a little bit of business development company. It's not a hedge at all. It's just more of a diversifier. So I'm going to show you right now how much income I've made this month. I've used multiple different apps, and so far the ones that I found that's the easiest and the most accurate to use is called Div Tracker. So I'm not sponsored by Div Tracker, but I do really like it. I learned about this from one of the smart investors from the Kamir's Discord. A lot of very knowledgeable and smart people in there. So I pick up things from everybody, some interesting things that make sense that I look through myself. So on Div Tracker, so it says, and it's pretty accurate, so I don't even really have to track because I've matched my tracking to it, and it's quite darn accurate. So it says that I make around, I would say somewhere between $5,000 and $7,000 a month in dividends. My goal is to hit 30K a month, which is a nice goal. But I'm about 24% there towards the goal. And year to date, I've received almost $19,000 and $18,927 in dividends. And dividends are coming in, a lot of them paying weekly, some every 4 weeks, some monthly, some quarterly, etc., so on and so forth. And you can see my dividend yield and yield on cost. So I've kind of graduated to I care the most about my total return. I do care about dividend because dividend income does mean a lot, because it can make the, it could be the make or break of, financial freedom. But once you have enough income, then I don't feel like, in my personal opinion, is once you have enough income to live on, or once you've hit that goal, I don't see a purpose of having more income if you're sacrificing total return. So I want to have total return first and foremost. Income is secondary, but definitely very important. It's very important in the beginning, but once you pass a certain level, like for me, it's 30K, I'm not only 24% there, or depending on the month, per month. Who knows how long it'll take. So with the dividend tracker, what I like about it is it shows you every year, and it shows this is without dividend reinvestment. So if I don't reinvest the dividends, a lot of the funds that we have, they sometimes lose in net asset. The value price goes down. When the price goes down month over month, even though they target a certain percent yield in dividends, the dividends will get less. If the price goes down, that's how it usually works, because they're giving us, let's say you bet 50% on a $10 stock. Later on, you get 50% on a $5 stock, your dividend is going to be less. And then if you have 50% on a $2.50 stock, your price will be less. So unless you're reinvesting everything, it shows you the projection. You could go on the app and you can go to settings on the bottom right, and you could type in drip. And you type on the top over here, you just do drip on for all of them if you want. And then you see a different picture. It shows you that if you do drip and snowball this in there, you can see your dividends going up year over year. Can go up, instead of dwindling down to 40K a year, it could be going up to 266K in a year. The thing is that I will eventually likely put the drip back on. Right now, I'm using all the dividends to divest it out. What I like about the app also is that it shows you how much money you have in each position. I am using a lot of margin, so that's not all of my money. But it also shows you percentage, right? So you could break down your holding by percent. So you could see my YieldMax, it used to be 44% or so, or maybe a little more. Now it's 42. So I'm slowly trying to chip away on that. It's too heavy in one underlying. I'm not going to sell for a loss. YieldMax has been going up a little bit. I'm enjoying it, but I'm divesting the dividends to build out these hedges. So as you see here on the bottom, I have SHLD, CGDV, SPMO. I want to get those to at least 1% a piece. I'm building out all the, all building out some strength in the portfolio. So now if you want to see how I've been doing, we'll compare week, month, year to date, and we're going to see compared to my fund versus VOO. And of course, I haven't done as good as VOO at certain periods of time. Let's take a look. So I made you guys a really nice chart. So here you have, on the top you have VOO and then the YieldMax in. So you can see in the past week, and this is all only price return, not total return. I did add a little bit of total return metric to the year to date, so you guys can see like a bit of more of a full picture. So price return 1 week, my portfolio did about the same as the VOO in the past week. In the past month, VOO is up 15%. I'm up 39%. But then again, also bear in mind when you do have margin, think about your portfolio as a leverage fund, because that's how I look at it in my mind. Tell me if that makes sense to you guys. If you have like 50% margin, whatever you buy, think of it like a 1.5x product, because you're using 1.5x leverage, right? So that's how I look at it. So I do have margin, so I have to think about my portfolio is being very risky. So of course that when the VOO is up 15%, it's not a surprise that I'm up 39.03% in price. But year to date, VOO is up 0.95%. That includes the whole up and down and everything. And then I'm down year to date 12.32%. Ouch, that hurts. But if I did add in the dividends for my portfolio, I actually should have also added in the 2 quarters of dividend for VOO. So maybe it's up a little bit more than that. Maybe it's up like 1% or so. So I'm actually down just under 1%. So pretty much just kind of broke even. So here's the thing, when you tell somebody, oh, I make 5,000 to 7,000 a month in dividends, on face value, it sounds impressive. But the thing is that, honestly, I don't know about you guys, but I don't feel comfortable using the dividends to cover anything in life. If I know that my portfolio is exactly where it started, if not, it's down, maybe 1% total over the year. In order for me to feel comfortable, this is my personal preference of using the dividends. Let's say you have 100K in a portfolio, the portfolio paid out 5K a month. So if I see that my portfolio is still at 100, if it's at 105K at the end of the month, okay, I feel comfortable pulling out the 5K. I'm back to where I started. But if I see that my portfolio is 100K, at the end of the month it's 99K. I don't care if I got $20,000 or $30,000 in dividends. If my portfolio is at 99K, I lost $1,000. I don't feel comfortable taking out the dividends. Does that make sense to you guys? So I'm looking to try to. I know that some of my funds do dwindle in NAV a lot of times. They do pay out a decent amount. But I say again and over again, breaking even is not considered making money because you do have tax ramifications if you're in a taxable account. That's my opinion. And I think I do have some basis to what I say. So I feel like you're in a taxable account, you need to more than break even. You're losing money on taxes, you're losing money on inflation, even if you're not in a taxable account. You could be in a Roth or whatever. You're losing money on inflation. The dollar, whatever purchasing power you have today, is not as strong as it's going to be in a year from now. So it's going to be weaker. So you do need to have some growth. So if I have funds that kind of go down in price, I need to pair them with funds that go up and stable in price to kind of counteract that or to take the loss. Right now, I'm not willing to do that, so I'm just kind of building up around it. The 1 year price return, VOO is up 12.41% in price. This is not considering the dividends, so probably maybe like 13-14%, somewhere in that window. And I'm down in price only 5.65. I'm sure if I add the dividends, I'm sure I may be a little bit on the positive side, maybe a little bit. But you see, not beating the S&P, but a lot of changes have been happening with the portfolio every single week. When I make the dividends, if you think about it, 5,000 to 7,000 is being moved over into strength, into safety. I mean, there's nothing safe in the market, but there's things that are relatively safer from history, looking at sharp Sortino ratios. So let's talk about my coming strengths. So the monthly income, like I mentioned, 5 to 7K, and this could fluctuate, right? It can go down, it can go up, who knows, right? The plan is to keep adding more to strength. I'm looking for dividend and, yes, non-dividend funds to complement the dividend portfolio. I need to look at all my vulnerabilities in the portfolio and try to mitigate those vulnerabilities. I need to patch up the ship. So I'm looking into GPIX. I know I made a video on that you guys could see. I will link some. I have so many videos. I'll link some of the big ones in my description. Possible contenders will be GPIQ, QQQI. So now these are not really diversifying per se. They are giving me some parallel diversification, which I'll make a video on that to explain to you what that means. But also the way the GPIX and GPIQ work is that they don't fully cap the upside. I have a lot of capped upside. So here you get some dividends. You do have partial capped upside and partial uncapped upside. So it helps help with, mitigate whipsaw. It kind of reminds me of the YieldMax fund that they have. They call it SPYI, which is like 60% is capped upside, 40% uncapped upside. I'm also planning to build up eventually. It may take me a few weeks or maybe a couple months to build up SPMO, CGDV, and SHLD. These are non-dividend ETFs, but they have great upside potential and they have different strengths. So I actually wanted to tell you guys that I do use ChatGPT. I find it very helpful if you like give ChatGPT a picture of your portfolio or your holdings. Don't give them any account numbers or anything like that. It can give you some idea. It has some interesting data. Again, you got to make your own judgment call, and I definitely would suggest to speak to a financial advisor. I'm not giving you advice, but I would say just talk to a financial advisor who knows your personal situation. But I'm going to show you something interesting. So I asked to list my biggest weaknesses, and I took a screenshot of the percent holdings of my. You can call your portfolio whatever. You can give it like a nickname if you want, and give ChatGPT updates of your where you're up to in your allocations. So how can I build it out or eliminate? I kind of gave it a suggested answer, so maybe you should kind of give it an open-ended answer. So ChatGPT says, I mean, it's pretty, no kidding, it's pretty captain obvious, but like, yeah, my portfolio is heavily concentrated in high-risk short-term income strategies, YieldMax, Tap Alpha, I guess it's 0 day to expiration. There's a lot of vulnerability, obviously like a lot of high-risk exposure. Definitely like option based, capped upside, a lot of funds that are rate sensitive, volatility sensitive, missed upside. Some, there could be some NAV erosion. There's a lot of correlate. I do agree. There's a lot of correlation overlap. Well, AIPI, GPT. I don't agree with everything chat says, but I do. AIPI, GPTY has a lot of. There is some redundancy, and then limited quality or uncapped exposure. Only 5. So no, this is new. See, I never had this before, but now it says that, my weakness is that I only have 5%. That means basically you need to build this up, which is great because I am building this up. 5% is in low risk, high quality equity. Thank you for the compliment that what I'm building up is low risk, high quality. So there's minimal exposure to, so basically build it up, keep building up some of the capped upside. You're too heavy. And then, how to build out and fix these weaknesses. So they say, add smart beta, quality growth anchors. I'm not sure they're going to be anchors because this will more be satellites, but they'll be stronger satellites. So SPMO is the momentum. So it rotates into strong sectors during uptrends. Add some alpha, CGDV. That's quality dividend value. That improves the Sharpe ratio, reduces downside. Again, nothing past performance, not future gains, but see how this thing is performing. Look at its report card and track record. GPIX or GPIQ, right? Partial call overlay. So it's lower NAV decay. Berkshire Hathaway, already included. Pure upside quality. And then there's the defensive layer. I mentioned SHLD, IDVO has, some international exposure. And then I guess I have some recommendations of maybe building up some SGov or something like that, to help with cash. The hard thing with me to overcome with SGov is that I do have to pay margin interest. So it's hard for me to make sense of putting cash into something like SGov that gives me 5% interest when I'm paying about 5% interest in, so it doesn't make it kind of feels like a wash to me. So, for me, if I wanted to build up some safety, I was thinking sometimes maybe instead of reinvesting all the dividends, or moving the dividends into other assets, maybe leave a few $100 in there from the dividends just to offset some of the debt. So I think reducing debt for me is a better strategy in my position. That's how I feel like versus going into SGov. So it's really interesting. I give you guys some homework. I don't want to give you guys homework, but just for fun, plug in some of your thoughts. It's a good, interesting, high-level AI that can help. Again, there are a lot of grave errors that I found, but it's just something, you got to take it with a grain of salt. Anyways, this is the Working Investor over and out. I hope you guys have a wonderful trading week. All the best.